Opinions expressed herein are subject to change and not necessarily the opinion of the firm. Past performance is no guarantee of future results. The information presented herein is for informational purposes only and is not intended to provide personal investment advice. It is important that you consider your tolerance for risk and investment goals when making investment decisions. Investing in securities does involve risk and the potential of losing money. The material does not constitute research, investment advice, or trade recommendations.
And now introducing Mr. Keith Lanton.
All right, good morning again. Got a lot to talk about. Global financial markets. Of course, we'll talk about what's impacting the markets this morning, coronavirus. We'll talk about some individual equity ideas and Barron's. Talk a little bit about the bond market. Then we're going to turn things over to Brad to give us some further insights into the financial markets. So we're going to get started this morning and talk about rolling over a retirement account and whether or not that may or may not be a good idea from a existing 401k plan, something that investors often think about whether or not that's something that they should or shouldn't do, and also something that advisors focus on as whether or not it's in the client's best interest to transfer money out of a retirement account that's in a 401k or 403b at an employer and move it to an IRA. Big decision. Lots of times the monies in a retirement account represent a very significant portion of someone's net worth and oftentimes represent an accumulation of investments over a very long period of time. So recently, the Motley Fool and Forbes ran an article on why it may make sense to and reasons to roll your 401k into an IRA, and also discussed when it may not be appropriate to transfer money from an 401k or 403b. We're going to use 401k as the generic all-in-capturing word here, into an IRA. So to start with, when it may not make sense to roll a 401k into an IRA is, and this is assuming that you have terminated employment, that you're no longer working at the employer at the company. If it's a plan that offers extremely reasonable or low fee choices, has a very broad array of choices, and you are a very detail-oriented investor, and that you are capable of staying on top of your investments, even if you, in all likelihood, would have investments in multiple sources or places, because it is fairly common that if you have a retirement account, 401k plan, you probably have other assets in other places, and if you keep it in the employer plan, if that's an option, you have to remember to treat that separately. That includes updating beneficiary information. That includes making changes to the investment portfolio when appropriate. That means monitoring the investment choices and changes in the plan. So if you're the type of investor who, number one, can stay on top of things, and number two, is in a situation where those choices are good choices, may make sense for you to keep your assets at the 401k provider, former employer. If not, you may want to consider moving your assets into an IRA, either with a investment professional or doing it yourself, if that makes sense for the individual. So number one is if you do move your assets, it's probable, although not definite, that you'll have more investment choices. Most 401ks contain a few investment options selected by the employer. You may not be happy with those choices, and even if you're happy, they very well may be limited. IRAs offer a virtually unlimited selection of investments, including stocks, bonds, mutual funds, ETFs, exchange-traded funds, and more. You can spread your money among many of these assets as you choose and change your asset allocation as often as you like. Didn't mention it, but some 401k plans restrict multiple movements, sometimes have restrictions in terms of how many movements you can make within a certain period of time. Although this may be something that most people don't realize, but oftentimes IRA fees are lower than 401k fees, and that's largely because most 401k plans have the assets in mutual funds, and with the evolution of low-cost trading and the evolution of ETFs, it's very possible that assets held outside an IRA may have lower fees. Also, if you're considering converting to a Roth IRA, you can't do that from your 401k. So if you're considering a Roth conversion, you may want to transfer to an IRA, or you want that option. Also, keep in mind that Roth IRAs aren't subject to RMDs, so once you make that switch and pay the tax, you aren't required to take the funds out on an ongoing place. And perhaps the most important reason, and Forbes really emphasized this, is rolling your 401k into an IRA lets you manage all your funds in one place. Perhaps you had multiple employers, you had multiple 401ks, you had IRAs, you had IRA rollovers. You can now consolidate that all into one place. And the importance of that simplicity is oftentimes a critical decision point. You can manage all your investments in one shot. You can manage all your beneficiaries in one shot, and perhaps make your life easier as you get older and as time keeps on ticking. It gets more and more complicated, and you have lots of other things to focus on other than remembering where all your accounts are and to make changes in all those different accounts. So, moving on to this morning, coronavirus is what's getting the attention of financial markets this morning. We saw this start on Friday. We have Dow futures down about 440 points. We have S&P futures down just under 50, down about 48 now. NASDAQ futures down about 163. We are seeing a flight to safety in the bond market this morning. We're seeing the 2-year down to a 144. That's interesting. The Fed's meeting this week, and the Fed funds rate is roughly at 150, so 144 on the 2-year is saying perhaps if this persists that we may see lower interest rates. Could be a knee-jerk reaction. 10 years at a 161, and the 30-year down all the way to a 207, so all of a sudden the curve is getting very flat again. This again could be a knee-jerk reaction. We'll see in this flight to safety as the uncertainty around the extent of the coronavirus, how quickly it spreads, how much it'll spread, leading to lots of quick conclusions, and time will tell whether or not they are correct or not. The Nikkei was down about 483 points, down about 2%. The Shanghai was down almost 3%, down 84 points. And in Europe, we're seeing markets down pretty much across the board. 2% is a good level. It's basically down 2 to 2.25 across the board, as we see risk off going on. With that risk off, we are seeing oil down at $1.47 to $52.72. In general, commodities a lot weaker outside of silver and gold, which are seeing a flight to safety. Expectations are that a Chinese situation where the consumer is staying home could pressure commodity prices, as China is the largest user of commodities. Wall Street Journal this morning talked about coronavirus. Says coronavirus is no small threat to travel. Says that the markets very possibly and perhaps even likely could be overreacting to the threat of coronavirus, but it is a real danger, at least in the short term, to travel sector. We see the number of cases picking up this morning. I think the last number I saw, and it's a moving target over 3,000. But the journal suggesting that the broader panic that we're seeing, and perhaps in the heart of right now, maybe and hopefully will be short-lived. Historical evidence from cases like the outbreak of Ebola in 2014, the avian flu in 2009, SARS in 2003. Those cases, if they're hopefully reminiscent of what we're seeing today, won't have much long-term impact on the global economy or headline stock indexes. Reasons to be somewhat optimistic, as opposed to what we saw in 2003 with SARS, as scientists are very quickly getting their hands around the virus and the method of transmission. Of concern, or a key difference between now and 2003, is that the infrastructure in China is significantly superior to 2003, and the amount of people traveling at high speeds and possibly spreading the virus is significantly augmented from 2003. Crisis also comes at an awkward time for the Chinese economy, whose weakness has already hit manufacturers across the world. Obviously, the impact of the trade dispute between China and the United States had already had an impact. So this is hitting them at a time when they are somewhat in a vulnerable state. European airlines, in particular, are being punished, given that they are the key gateway into and out of China. British Airways down about 13%, Lufthansa down about 9% this morning. Some other updates on the situation in China. The mayor of Wuhan, which is where the epidemic started, has offered to resign and taken responsibility. China extended the long Lunar New Year holiday to limit travel over there, and some interesting delays here, which could impact the global economy. In Shanghai, which is China's financial center, the authorities ordered businesses to stay closed until midnight on February 9th. In nearby Suzhou, a large manufacturing hub, businesses there were ordered to open on February 8th. And some schools have been ordered to stay shut through mid-February, and then the situation will be reassessed. Schools in Hong Kong also being closed. Now, to put things in perspective, though the number of coronavirus cases and deaths is alarming, there is lots of public health experts warning against mass anxiety. Keep in mind the common flu kills 35,000 people a year, hospitalizes 200,000 people, and that's in the United States alone. So it's way too soon to jump to any conclusions, to draw any expectations about mortality or about transmission. But health officials are urging to keep the flu numbers in perspective, as you see these numbers here from the coronavirus, which may be another strain or type of flu that is spreading. Some other travel statistics that I saw a few minutes ago in Macau, which is the gambling hub of China, to put numbers in perspective. The first day of the Lunar New Year, visitors were down 35% due to travel bans, restrictions, and concerns. And the second day was a 59% decline in terms of number of visitors from a year ago. So clearly there is some impact taking place from these bans, and they will have some economic effects. Here in the United States, we got some earnings this morning from D.R. Horton, the home builder, symbol DHI, had much stronger earnings than originally expected. Starbucks reporting that they are suspending delivery and closing stores in some provinces in China. Boeing in the news with some positive news. Boeing completed a successful maiden voyage of its 777X over the weekend, which is a much-needed boost for Boeing, given all the concerns about the 737 MAX. Taking a look at what else is going on this weekend, and as Barron's points out, that this economic data that's coming out this week and these earnings that are coming out this week may not necessarily get the attention they usually get during this week, but possibly will be looked at once people are able to further digest what's taken place with the coronavirus and the concerns surrounding that. But we do get a lot of information this week. Today we get the Census Bureau reporting on new home sales for December. That's supposed to be 728,000 is the number that's anticipated. Tomorrow, earnings from Apple, eBay, Advanced Micro Devices, Pfizer, Starbucks, United Technologies, to name a few. We get consumer confidence tomorrow. That's expected to be 128.4. Wednesday, Fed meets, expect to keep interest rates unchanged, 150 to 175, the target range on the Fed funds rate. Wednesday, more earnings, AT&T, ADP, Boeing, Facebook, General Electric, MasterCard, McDonald's, Microsoft, PayPal, all on Wednesday. Thursday, the earnings parade continues. Altria, Amazon, Amgen, Coca-Cola, Electronic Arts, Eli Lilly, United Parcel Service, Verizon, Visa. Thursday, we also get the Bank of England announcing its monetary decision. Futures markets today are predicting a greater than 50% chance that the central bank will cut its key short-term interest rate to 50 basis points from 75 basis points. Friday, we get earnings from Chevron, Texaco, ExxonMobil, as well as some others. And also on Friday, we get personal income, and we get spending as well. And then we also get the Chicago PMI on Friday. So clearly lots of information for the markets to digest. Barron's talked about the weakness we saw at the end of last week, attributing certainly some of it to the concerns about the coronavirus. Barron's also emphasizing that there has already been in this country 120,000 hospitalizations from the flu, 6,600 deaths from the flu, and I think the number of confirmed coronavirus cases in the U.S., although it's a moving target, was about 8. So again, put that in perspective with the flu that we weren't worried about, and perhaps you get some more perspective. So before the coronavirus made headlines, risk markets were already exhibiting signs of being ready to take a breather from the austerity advance to record prices and skimpy yield premiums. Many metrics had showed the markets to be in overbought territory. Call buying was literally at almost all-time highs, somewhat of a significant contrarian indicator. All of this helps set the stage for a pullback with the coronavirus providing the catalyst. Interest rates, though, have remained and the primary underpinning for stocks. And with interest rates ticking down this week, we'll see what impact that has. But the focus of Barron's, and perhaps what they're suggesting is one of the main culprits for some of the weakness that we're seeing, had to do with the Federal Reserve and the fact that the Federal Reserve has been cutting back on the amount of money that they've been injecting into the monetary system. The central bank had been expanding its balance sheet by over $300 billion in September. We talked about this a little bit before. And what they've been doing is they've been injecting that money into the system through through repurchase agreements, which are in this case tied to very short-term Treasury bills. And the Fed has insisted that those operations don't constitute quantitative easing, which is what the Fed calls when they purchase long-term securities. Here we're purchasing Treasury bills. And the Fed saying that there is a difference between the two. But other participants are suggesting that $300 billion that's been injected since September is a distinction without a difference, and it has had a significant impact on the equity markets. What the Fed has been doing is in the last since the start of the year, in the last couple of weeks, the Fed has stopped expanding its balance sheet and has actually contracted its balance sheet by about $25 billion. The Fed has said that it would continue to repurchase about $60 billion of Treasury bills a month. At the same time, though, it's been winding down its repo operations, letting its holdings of agency mortgage-backed securities mature without being replaced. Barron's saying that it's probably coincidental that the stock market has stumbled, but it needs to be watched. Perhaps that is having as much or a greater impact over the longer term than anything else that we're seeing. Talking about those low interest rates, we've talked before about the fact that when we see a 10-year below 3%, that in the long term that's bullish for stocks. Another report's out. James Paulson did some research, and what he found is that when the yield on the 10-year is over 3%, and obviously we're at a 162, I think Keith Douglas told me a few minutes ago on the 10-year, and when the yield on the 10-year is over 3%, an all-stock portfolio has outperformed an all-bond portfolio by 2.3 percentage points per year. Sounds great. 2.3% better even when the 10-year is above 3. When the 10-year is below 3, stocks offer more than 6 times that return. So that 2.3 times 6 is the average return when the 10-year is below 3. And we'll see if that continues to be true this year. A couple of ideas from Barron's. One item that Barron's talked about, one story, one theme, had to do with eSports. What are eSports? eSports are recreational viewing of other people playing video games. And those who are older may view this as a market of little interest, but nevertheless it's something that is sweeping the younger generation. Just a couple of weeks ago, fans were packed around the Jumbotron in a 20,000-seat arena in Paris to watch the G2 eSports of Europe take on the Fun Plus Phoenix of China in the finals of a tournament that involved 24 teams from 5 continents. And the most fascinating aspect of this is not the 20,000 people who were in the arena, but the number of people who were watching it online. 44 million viewers watching simultaneously. The average per minute of viewership was 21.8 million people. To put that in perspective, Game 7 of last year's Stanley Cup Final peaked at 10.4 million viewers, averaging a total audience of 8.9 million viewers, and that was the most watched NHL game on record. So almost 3 times more viewers watching eSports than watched the NHL most watched finals in Stanley Cup history going on there. So eSports is a market that's certainly in the crosshairs of the big tech companies, Amazon, Microsoft, Google, and Facebook, all competing for a slice of the eSports live streaming business. Who's got the lead? Some suggest that perhaps Activision Blizzard, ATVI, and perhaps their recently announced partnership with Google, which is a multi-year strategic relationship in which Google Cloud will be the provider for Activision Blizzard's game hosting infrastructure, and YouTube is its exclusive streaming partner worldwide. That excludes China, who has banned many of the U.S. eSports viewers in their country. They've set up their own competing viewership for Chinese viewers, perhaps something that the trade agreement could address. Nevertheless, Amazon also a big player in this space. It acquired the Western live streaming site Twitch. They paid $842 million for it in 2014. And although Amazon doesn't break out revenues for Twitch, estimates are that revenues exceed $500 million per year. So something to watch, eSports, and a whole new genre of entertainment, watching other people play video games. A couple of other ideas in the equity market. Share with you, Barron's had their roundtable. Scott Black, his ideas I thought were the most intriguing. So he's the founder and president of Delphi Management, so I'll share some of his ideas with you. One company he suggested taking a look at is Science Applications International. Symbol there is Sam Apple Ida Charles. They provide technical engineering and enterprise information technology to the U.S. government on large projects. 54% of revenues go to projects with the Department of Defense. Stock is trading at around 14 times earnings, expected to earn $6.25 a share. Company is expected to grow revenues about 10% per year, according to Scott Black, and earnings expected to increase 10 to 15% per year. And the company, again, trading around 14 times earnings. Symbol there is SAIC. What's the price target? Well, he compares them with their competition, which is Booz Allen, as well as another company called CACI. Both those companies trade north of 20 times earnings, so he says there's plenty of room to run just on multiple expansion alone, not even factoring in the growth of earnings. Also positive on Royal Caribbean. This is a name that certainly will probably be under pressure today, symbol RCL, saying they're adding more capacity. Net income is expected to be $10.75. Obviously, that might adjust slightly from this outbreak here. This year, it's investment grade. Dividend yield is 2.3%. It's trading at about 12.2 times earnings, and the return on equity is about 18%. He was asked about the coronavirus and whether or not it affects his thinking. Of course, this may have changed since he wrote this, but at the time when he responded, he said no. This will pass as well. Merrill Whitmer chimed in on the idea about Royal Caribbean. and she reiterated that the aging population really enjoys cruises. It makes for an easy travel experience for the elderly. They don't have to pack, unpack, get up, and move around quite as much as they do on a traditional vacation. And they can bring their kids, grandkids, and they tend to enjoy cruising as well. So great opportunity for the whole family. And Scott Black pointing out that Royal Caribbean has 4 price points. So they have the Royal Caribbean brand, which is moderate to upper. They also have Celebrity Cruises, which is a bit higher, and they have Silver Seas at the very high end, and then they have a specialty brand, Azamara Club. A couple of other ideas. This one I thought was real interesting. Name of the company is Enersys. The symbol is ENS, Eddie, Nancy, Sam. It's an energy storage company for industrial applications. And what they're able to do is store energy in batteries. And their biggest market right now is forklifts, because in forklifts you can't use combustion engines. You'd kill everybody, like, for example, in an Amazon distribution center with carbon monoxide poisoning. And industrial applications like forklifts are about 44% of sales, but they want to bring it down. They also have a business in uninterruptible power source, which is about 29% of sales, and that business is expected to pick up. And he cites 5G installation as one of the main reasons why that business will pick up. There are about 30,000 5G towers nationwide, but with the installation of 5G, you're going to see a lot of mini towers being built because they don't require as much power, and they don't require the size and scale in order to penetrate space that the towers that are in place now pre-5G require. So all these new 5G mini towers are going to need backup batteries, and Enersys is one of the leaders in potentially supplying those batteries. Enersys also provides backup power for the cloud. Companies like Comcast are their clients, as well as Amazon and Microsoft. They also sell to the electric utility grid. So he says, in his opinion, it's the kind of business where, irrespective of whether or not you have a recession or not, you have the opportunity or the potential, I guess, for double-digit earnings growth. All that story comes with a multiple, at least at the time of this writing, of about 12, and a dividend yield just under 1%. Finally, Scott Black reiterated a stock he suggested last year. This is a stock for those looking for income. It's a business development company. It's called Hercules Capital. The symbol is HTGC. Stock is 14. At the time of this publication, it was yielding about 9% on HTGC. Before I turn over to Barron's, to Brad, I mentioned one other story from Barron's, and it had to do with Netflix. Netflix came out with earnings last week. Initially, the stock sold off. Then it rebounded on some optimism about international viewership. But Barron's was skeptical about one item that Netflix did last week. And what they did was they changed how they measure viewership. So going forward, Netflix will count a household view after 2 minutes of watch time versus the prior method, which required viewers to complete 70% of a show or movie. Obviously, that's a significant change. Before you had to watch 70%, now you just have to watch for 2 minutes and decide whether or not you like it or not, but nevertheless, that'll count as a view. So some analysts and Barron's are skeptical that making this change is something that Netflix is doing in order to maintain its momentum, in order to make it look like more people are possibly watching or viewing their content than under the previous metric. And that's something that bears watching, and they say they are concerned about. That's everything I've got. Going to turn it over to Brad, talk some more about the financial markets this morning. Good morning, Brad.
Good morning, Keith. Good morning, everyone. Thanks. I hope everyone had a great weekend. Just my usual first anecdotal story of the morning is I was at a party on Friday night. Everybody is talking about stocks. Everybody's talking about what they own, high flyers, this, that. That's never a good sign for me personally. It makes people feel badly that they didn't participate in this market the whole way, and most people did not. I think that there are people that are trying to chase this market, and it's always concerning to me, and I think I try to think about it over the weekend, how it affects me as a trader, and the advice that I give people and my family. Speaking of family, it really just over the weekend with this real outbreak of convirus and the death of Kobe Bryant, you have to think about what's really important, and what's really important is your health. Take care of yourself, your family, and it's just in contrast to the greed that I was hearing on Friday, it was just a real reality check. So back to reality. Just a couple comments about the bond market. Obviously, the Treasury bond market is through the roof here, just screaming for risk off. That could change on a dime, obviously, because there still is a lot of pent-up demand in the stock market, and a lot of people who feel they missed it and want to be involved. What we're offering right now, if you look at my offerings today, we have some 15 to 20-year municipal bonds. We have some Miami-Dade County, Florida transportation bonds, and some New York State Dorm Authority for State University bonds that are trading at better than 130% of where treasuries are trading. And I think that for the people who want to take a little risk off, it's not a horrible place to be. There are no guarantees that these bonds continue to go up in price, but they've certainly gone up a lot less than everything else has. That being said, if you look to sell a municipal in this range, you may not get the bid that you want because this part of the market hasn't rallied, which is why I like it if you look to buy a municipal. I still believe in upgrading credit and not buying those 40 and 50-year bonds. So that all being said, sorry for my personal opinions, but just want to give everyone a heads up of what I'm thinking and just keep it real, keep everything balanced, and and additionally, when you speak to your clients who may be upset that they missed out on something, just take a deep breath and tell them that reality is much different than some of the stories that you hear at cocktail parties. Thanks.
Thanks, Brad. Brad, what are you seeing in terms of the muni market? Is it participating this morning similarly to the strength in the Treasury market?
The municipal market in that it is not at the same level. I'd say the municipal market is up 1/8 to 1/4 of a point, and versus the 10-year Treasury, which is up 5/8 point, and the 30-year Treasury, which is up 1.25. So the municipals have not rallied as much, or I'd say that over the last week, with the government bond rally being up about 3 to 5 points, municipals is up a point. So I still think that there are opportunities to buy these 15 to 20-year municipal bonds. The short range of the market is extremely tight. As I said, I never see a need to go out to 40, 50-year bonds unless you're really looking to play a big bullish move in the bond market, which I personally would not do that here.
Okay, thank you. Yeah, so maybe again, if you're looking to risk off the munis, perhaps the more attractive fixed income asset class.
The corporate bond market has had a very big rally with the treasuries, and that corporates really tend to move, especially high grade corporates, tend to move tick for tick with the treasuries. The lower grade corporates, for those who are looking at high yield bonds, obviously move a little bit more with the equities. So the high yield bonds could be off a little bit today.
Thank you. That's everything I've got.
Thank you for listening to Mr. Keith Lanton. For more podcasts, please visit our website, www.lanternwa.com.